Something could be worth $10 million, but the seller is distressed. They can't pay the mortgage. They got problems. You can come in and offer them 7. You can do that? Yes, you can get a great deal. And you can transact and you can buy at a steep discount if you find the right situation. That's why I love real estate, because you can make money on the buy. So when you buy something for 7 and theoretically it's worth 10, I give you an extreme example. Maybe that kind of discount is hard to find, but you can still get a 10% discount, right? It's possible with a set of circumstances. That's why private real estate can create asymmetric return opportunities.
Welcome to the Path to Passive podcast, where we talk about building wealth and empowering lifestyle through commercial real estate investing for tech professionals. I always wish that other tech professionals reaching financial freedom had documented their journey along the way, so I'm doing it for the rest of us. Join us as we explore stories, many failures, and lessons learned along the way. I hope you enjoy and subscribe. Mike Zlotnik, dude, thanks so much for being here. I have had immense joy already, just kind of talking shop and sports and just, talking tech. And we're going to talk about real estate here, of course. I'm happy to have you here because many of our listeners, of course, this is real estate investing for tech professionals. Of course, we'll talk about other things too, expanding that audience, expanding the guests, their expertise too. But what I think is really cool is your background from being in tech and decisions you've made to get where you are now. Not only fund manager, but Big
Mike Fund podcast.
Yes.
Cheesy name.
Amazing name. What are you talking about? BigMikeFund.com, right? As well for the podcast as well. And, as a fund manager, as, background in tech, just there's so much that you can share about looking, back to many of the people that are on the path now. And so that's why I'm really excited to have you here to share some of those insights and answer some of those questions. Like if, which has a little bit more resonance of if someone were to ask you, knowing what you know now, back then, what would you do? That type of stuff. But we'll get into those things. Would you please just give, a quick background for yourself so that you can maybe talk about some of your highlights and then we'll get into some of the questions.
Steve, thank you so much for having me. I've already enjoyed the conversation tremendously. And I'll run a short story of my life. So again, like James Bond movie, From Russia with Love. I'm not from Russia, I'm from Moldova. So I come from Moldova with love. Moldova is a small republic of the former USSR. I came in 1989, US citizen, US patriot, US educated. I was a geek. I went into the IT field for obvious reasons. I was a mathematician and I was a chess master. So I really enjoyed that part of life. So it was almost natural to study math and computer science. And I kind of settled down upstate New York, went to school in Binghamton, New York, lived in Rochester, New York. And then I entered my tech journey and spent almost 15 years through various startups, all the way to bigger companies. But really a lot of fun was in the technology developments firms. And then I discovered real estate passively in 2000. Just buying my first apartment in New York City. And I never looked back. I very much enjoyed that part. So there's a point in time in 2009 when a little burned out, just to be fair, and I wanted to switch. And that was a perfect time. So I went real estate full time. And what's really important, I just add this comment. I learned this in the tech world, right? And it's one of the things that we talked about. It's like be in your genius zone. Whatever you do, be in your genius zone. What the hell is a genius zone? Well, it's something you're really good at, something you love, and something that you're very productive at. Mm-hmm. And then find that if it's tech. If you move on and you find it in real estate, that's wonderful too. So I figured I love tech, but my genius zone was really real estate because I had more, I don't know what to say, passion for it. It just happened one day that I thought I'd be better fit. I'd enjoy my life a little more in real estate versus the high-tech world. And I'll tell you one more comment and I'll shut up. Tech is wonderful. But what I didn't like about tech, software deployment at 12 midnight.
Yeah.
And you have to be on. And then you have to be on for multiple hours because you can't, customers join 8 o'clock in the morning and your system is down. Can't have that. So you got to deploy. You have to test. If it's all good, then you can go to sleep. And if something is wrong, you got to roll back and test again. How fun is that?
Yeah, it's so much fun. So much fun. I'm fortunate to not have to do that anymore, but I still have those nightmares of that similar experience. So I love that. From Moldova with love, mathematics background. I've got to ask from a chess perspective, do you know what your ELO is anymore?
At the peak here in the US, right? I had over 2,400 rating. Formerly, I had a 24 something. They send me US Chess Federation, send me a nice certificate, senior master and a life master. Now I suck. I got much worse. I play on chess.com. My rating is like between 2,000 and 2,100 in Blitz. That's all I do from time to time. I'm getting old and slow.
Well, that's still really cool, man. But I'm so glad that you started with, talking about being in zone of genius, right? Being zone of genius and what you like and what you're good at. That's a topic that I am constantly harping on, and I want to talk about that. But one of the questions that I started asking, more of, instead of like, how did you get into real estate, was more about like, what was the catalyst? What was the reason why did you get into real estate? And I asked this question because it seems like the reasons are obvious, like, well, for other streams of income and this and that. But I feel like in the responses I've looked at, some of the reasons are a little bit different. And so I didn't want to take that for granted. So I wanted to ask you, why did you get into real estate? You talked about being burnt out from tech, but were there other circumstances or other things as well? Because I think that's really helpful to kind of shake the listener, those are thinking about, that reason as well, to invest, as an example, to be like, oh crap, that is me. You know what I mean?
So fairly easy for me, right? You get married, you need the first place to live, right? So the shortest answer is you want to buy a place. This is very normal for a lot of people. As a single, you're comfortable renting. Sometimes people live in rent with roommates, but at some point you need a place, right? You got married. So instead of renting, we wound up buying our first apartment in Brooklyn fairly quickly, kind of took the savings, bought it for cash, and then worried about mortgage later because we need a place to live. So I started with a need for a primary residence.
Mhm.
It's probably the first investment in real estate people should make because you save on rent. So you immediately have a savings and then you own the place and it becomes an investment vehicle because, if you're in a coastal market, properties do appreciate. You may not cash flow well, but you'll over the years, the asset will grow in value. That's my pretty basic reason. The 2009 switch to full-time was a different timing. Just I invested over the years passively, and I kind of saw the power of appreciation. It's a slow, predictable, steady appreciation. At least New York City has been this way in non-volatile market. It's not Southern California or Southern Florida. There's no yo-yo behavior. It moves up at predictable pace. At least has moved in the past. And the cash flow from these coastal markets is not great. So you can't really make the argument for coastal markets. But predictability is the word. I just like predictability. You have a pretty decent idea what's going to happen. And as an investment, us techies, mathematicians, computer programmers, system admins, etc., we basically come to the same conclusion. We want to have a pattern. It's, if and then happens, right?
Yep.
So it's not a guaranteed thing, but a likely predictable thing.
Yeah. And I mean, that's the other part of, the exact lead in, because it is, like you're talking about, predictable, but you're also looking at, well, the predictable cash flow. And so you got your own place, of course, makes sense, had the family. That's why real estate is so great to begin with. Roof over the head. Everyone needs a place to live. Everyone needs a family with, place to live, place to live for the family. But you also saw that, yes, it was the streams of income. And so, that path to ultimately going in full time, how did you make that decision?
Well, today that we are all about exactly that. So I would say today we really gravitate towards predictable income-oriented deals. So like the recent deal we literally just closed was an absolute triple net industrial property, which has wonderful characteristics of a long-term lease with predictable rent escalation clauses. It's all mathematics. As long as the tenant is there and they're going to stay and you underwrote that, you have current income computed very mathematically. Triple net means the tenant pays for all the expenses, including insurance growth, taxes, even CapEx. And then you have every year rent growth, in this case, 2.75%. So you could look at this is like as predictable as it gets. Now, not everything is like that, but the idea is exactly along the lines of cash flow today, predictable. Your margin of variance is very small. You're going to get what's predicted with small possible variance for little things. But it's, we're used to tech, kind of in the tech community. You have your day job, you buy stocks of Google and Nvidia and all the cool stuff, right?
Sure.
This stuff, but they don't cash flow that. I mean, like sometimes companies start a dividend yield. Google has like a tiny dividend yield. You're not doing this for cash flow. If you need cash flow, the better predictable asset is certainly real estate. You can't get a yield out of even S&P 500. It's very low yield. So that stuff is cool for other reasons. It's the growth, it's the excitement, the world is changing, it's the revolution. But if you want to diversify and have some things in your portfolio that are just much more cash flow oriented, some of these strategies can make a lot of sense.
I'm glad you bring this up, Mike, because, I've heard you talk about making sure, and I can't remember exactly how you said this, but the idea is cash flow first. You've commented on, the people that are crazy about doing land development. It's like, they can develop all of these properties and hopefully they'll get the price they want to once they have everything built up and, sold. Who knows what the market will be like 18, 24 months later or whatever. But being able to just get into assets that are cash flowing right now and based on where the market is at, right? Buying it at a discount or something else, but really having cash flow first. And that comparison is like you did around what people are more familiar with, how techies are more familiar with typically, right? Of stocks and the things that make the news, right? A lot of noise. But let's talk about this from sort of, like two personas right now. The person that might be hearing this, techie that might be hearing this for the first time or maybe the second time, it's like, oh man, that makes sense. I should go invest. What would you tell them? Can you make some more comparisons or tell some more about why, alternate investing or investing in syndications or funds make more sense than stock market?
Sure, they're different, and you touched on a couple of really great points, and I'll cover them all. So the first, you touched on speculation versus investing. This is back to for those who study the Godfather, like the movie of investing or value investing with Benjamin Graham. Warren Buffett learned from Benjamin Graham. And Benjamin Graham defined investment as an operation that has safety of principal and an adequate rate of return, just the paraphrase. So that's the same way I look at investing in real estate. When you do a ground up development, redevelopment, repositioning, it's a speculative operation. You're speculating that by the time you build whatever you're trying to build, you will get the price that you want to get, and you're not going to get stuck with the mortgage payments and no cash flow. The risk is you build and you can't sell, you got a problem. Okay. Has happened before, and you could actually lose a lot or everything, right? So if you don't want to speculate, then you got to go into the investing arena. In the speculation arena, you can have much greater potential upside. No question about that. So if you're comfortable, you're young, you want to lose some money, okay. You got to have the attitude. You don't want to lose some money, but you got to be prepared for the roller coaster. Market has cycles. So in the investment arena, you're now trying to have a margin of safety. That's another term that you hear from the value investors. And margin of safety in income-oriented investments with conservative leverage is typically, I just give you an example that I really like to focus on. It's the difference between what is known as the capitalization rate. And I'll explain what a cap rate is. Cap rate and the interest rate. So think of it this way. Cap rate, when you buy a property for cash, like literally no mortgage, and you bought it for $10 million and it's giving you $800,000 of net operating income. It's rent minus expenses that you pay, taxes, insurance, right? That income, $800,000, divide by 10 million you pay, that's 8%. That is the cap rate. That's how you measure cap rate in real estate. Mm-hmm. So the cap rate minus the mortgage rate. So the mortgage rate is what you borrow at. So if you borrow at 6.5 and you have 8% cap rate, you have 1.5% positive spread. That's a margin of safety. That gives you cash flow And the fact that you have leverage, the cash flow is magnified. What I don't like is when you have the negative spread, which people have done. Mm-hmm. That cash flow, that leverage makes it worse. It magnifies the negative effect. So just remember, real estate trades on leverage is a beauty and a curse. It works both ways. So as you have positive spread, and then you add some conservative leverage, like 65%, your cash flow can increase. So instead of 8%, you can wind up getting 9.5, right? If you start with a negative number, it's just going to get worse. It's just going to shrink, move to less and less. So that's the first point I wanted to convey: speculation versus investment, margin of safety. When you buy today in real estate, it's one of the reasons, by the way, I got into real estate. It's one of the few fields that you can make money on the buy. Mm-hmm. Right? When you buy Google stock, do you know is it going to go up or down?
No idea. I mean, it's based on what you can read in the news, unless it's insider trading, which is, a different story.
Exactly. So stock market is very efficient, right? This is the beauty of a stock market. It's liquid and efficient in theory. So information travels fast, and the stock price reflects all the participants in the market and their supply and demand, right? In the real estate, one of the big advantages why go into private real estate, information is not very efficient. You may have motivated seller situations. You may have very inefficient deals, meaning that you can actually get a great deal. Mm-hmm. You can buy well below what it should be based on your review and underwriting. So something could be worth $10 million, but the seller is distressed. They can't pay the mortgage. They got problems. You can come in and offer them 7. Mm-hmm. You can do that? Yes, you can do that. You can get a great deal. And you can transact and you can buy at a steep discount if you find the right situation. That's why I love real estate, because you can make money on the buy. So when you buy something for 7 and theoretically it's worth 10, I give you an extreme example. Maybe that kind of discount is hard to find, but you can still get a 10% discount, right? It's possible with a set of circumstances. That's why private real estate can create asymmetric return opportunities versus the risk that you're taking by buying right in the right market, in the right market cycle, the right location, the right type of asset. So I think I answered the second part of the question.
Not only that, but you just kind of gave this masterclass about markets, as well as cap rates, which most people have a very difficult time to even explain on its own. Talk about efficiencies and private market benefits as well. So
listen, I'm trying to help. If I touched on a couple of good points, so be it. I'll take the blame.
Yeah, it's super, super important. I'm going to highlight a couple there because, for anyone who wants to really understand what probably took you years, I would imagine, to really understand, to articulate so simply. And I'm sure, again, as techies, we can understand that. Like, if you can't explain something simply, then you don't really know it as well. But that is worth going back and listening to. But the idea of real estate versus stocks in, that bullet point aspect here too is just because from this perspective, you're going to be able to take advantage of something like private markets that you're talking about. And of course, prioritizing, and that produces opportunities of really great and stable cash flow first as well. And so let's talk about that, because the next thing here is, okay, great. So cash flow first, prioritize that versus dumping money into something else to, grow the net worth as an example. Now, you've been in real estate for a long time, right? For a while. I haven't done the math, but I've looked at your resume and it's quite some time. And so I'm wondering, when you've talked about different assets and locations, et cetera, right? Have you and your team looked at different types of assets over time, or has it been the same one and just kind of, survive until 25, in a certain asset?
Well, it's a multifamily expression. Now it's survive until 26. So yeah.
Yes.
Happy to talk on that topic. Yeah, we happen to have one distinct advantage over many other single strategy operators. We are actually, the best way to describe what we do, we marry money and opportunity. We act as capital partners, like mini private equity, private investment bank. So what we've developed is deep knowledge in multiple strategies. And I can't claim a perfect expertise in everything. A jack of all trades is master of none. But we know enough about many of these strategies, and we've invested in many of these strategies. So we've basically gone through, deep dive understanding how they function. And give you a quick overview. We've seen obviously multifamily significant roller coaster experience with the Fed hiking fast and furious. And I like this phrase: the Fed got all drug addicted to the ZERP. It's you have cocaine, you have crack, and the Fed gave a zero interest rate policy ZERP.
Sure.
And then when they reset the market because they had to fight inflation, it was a fast and furious and higher for longer interest rates. All that turned out to be very painful. And why multifamily got beaten up so badly is because a lot of the deals were value add and they were trading on floating rate debt, and it's a risk, it's a danger zone. So, and let me just cover a few other asset classes, and then you can kind of see. I'm just going to touch a few. Self-storage, multifamily. You've got retail, office, and then you got industrial. I'm going to cover all these, and then we can dive into other ones if you want. Monthly rent, self-storage. Supply versus demand is a huge factor. We've seen big problems in storage with oversupply. You build another facility too close to another one. You can't grow demand fast enough, but you can destroy supply side of the balance. So storage is a wonderful asset class when there's limited competition and you got pricing power because you have monthly rent. You can push the rent up next month and the next month and the next month. What happens if you're oversupplied? The rent can fall and the competition starts lowering rates and pricing wars. On the multifamily front, we saw a very significant oversupply, especially Sunbelt regions. So you had negative rent growth. It's still negative rent growth. That's the crazy part. If you look at the data for last year, like Phoenix, Austin, Sunbelt, many of these regions still showing negative rent growth, even though they're trying to absorb all the supply, and the predictions 26 finally all turn positive on the rent growth side. So you've got significant oversupply of product. You've got negative rent growth, and you have a very significant inflation that hit multifamily market. Insurance spiked. You had labor, supplies. So it got out of control, plus post-COVID moratoriums on collections. That asset class just got beaten up on so many directions. And you can say, is this the deepest value today? Maybe in some time from now, because it has fallen more than other asset classes. But the recovery is not certain. It's one thing that I was on another podcast, people ask me the question, compare now versus GFC, Great Financial Crisis, 2008, 2009. And if I remember one thing from that cycle and this cycle, the reset is fast, recovery is slow. So I don't know what the recovery will look like, but I'm a little bit concerned the recovery may be slower than we all hope. Now you go into, let's call it, office is a separate beast. It got completely decimated on the demand side by the new trend. People don't want to go to work, right? They want to work from home. So office, it's just the fundamentals have changed. Now you go open air shopping, and we'll get to industrial. Open air shopping, long-term leases. So we had 1 month, 1 year on multifamily, and then you go 5 to 10 years, typically on kind of commercial leases, the Starbucks of the world or the Cheesecake Factories. They have longer-term leases, so you have more predictability. And the beauty about that asset class has always been conservative in its financing. Fixed rate debt, 65% leverage. Triple net industrial or flex industrial is a very similar picture, but the lease now can go even longer term. It can get to 20, 25 years, and each commercial lease has well-defined rent escalation clauses. Mm-hmm. So back to your cash flow questions, where do you get the most predictable cash flow? Well, with the most well-defined rents and the most well-defined rent escalation clauses. And the closer it is to triple net, the least expenses you worry about on the inflation side, right? It's all tenants' problems. That's why open air shopping and industrials have done remarkably well. And the forward outlook, okay, inflation stays sticky, they'll still do well because it's all problem of the tenant, not the landlord, right? So that's, if you're focusing really on a cash flow, then those asset classes, they trade at the higher cap rates, so better cash flow. They're more predictable and more steady eddy. Maybe their appreciation doesn't have the same huge potential if the market suddenly recovers in multifamily and you have a fast demand growth. But it's a predictable cash flow focus, conservative leverage type of strategy. We love it. It's a matter of personal choice. Some people prefer a little more volatility, a little more upside. But if you want predictability, those strategies have worked pretty well. There are a few other things I'll mention. There's car washes, there is senior living facilities. Just differentiate between passive real estate and an operating business.
Mm-hmm.
Car wash is an operating business. Senior living facilities is an operating business. Storage is an operating business. As much as you don't want to say it, it is an operating business. Multifamily is actually semi-operating business. You got to deal with tenants and toilets. You truly go to less operating and more predictable with the long-term leases and commercial assets. Again, open air shopping, industrial,
Mobile home parks.
and mobile home parks is definitely operating business, big time operating business.
Yes. Okay, so here's this tease up for the next question, right? So we know cash flow focused. We've talked about stock market versus real estate, and you have given this really cool kind of survey of these different assets based on their, I'll say, I don't want to say market cycles, but they kind of are, right? The monthly, I don't know, what is it, like yearly, et cetera, et cetera.
It's not periodic on time. The market cycle is for sure is a great concept. I'll just say two things on this and I'll shut up. So for those who study market cycles, Howard Marks he has a book called Demonstrating Market Cycle, and it talks about stocks, but they're just as applicable to real estate. The cycles are different, but they exist in every strategy. The market cycle for multifamily maybe have gone through a deep recession and now in a slow recovery, while the market cycle for industrial and open air shopping, they're still in the hyper expansion. So they exist, but the cycle has 4 phases: recovery, expansion, hyper supply, and recession. And it goes again and again, and different things go through different cycles at different times.
Yeah, I misspoke.
Some cycles are long, some short. It's not a year or two. I know what you meant. I'm just giving a little color that it's just a little different. I'm not trying to be the wise guy. I'm just trying to say that I think you meant the right thing. I don't know when the cycle starts. I don't know when it ends, but it's inevitable that it's going to happen sooner or later.
Yeah. Thank you for calling that out. And Howard Marks, his stuff is fantastic. It's like Oak Capital or something like that, right?
Yes, Oak Tree Capital. He's the founder of Oak Tree.
Yeah. But what I was teeing up to ask you is, if we're still keeping this persona of someone who's investing for the first time or relatively, newer, right? Even if they're doing their second investment, there's a lot of things to invest in. You said, even yourself here, that things run in cycles, but we don't know exactly what it's going to, be like. No one has the crystal ball. But at the same time, the question is, well, what should they invest in? And I'm not saying go, for you to comment on, well, go invest in this, but what are things that would be good for newer people to invest in? And I know that it depends here is kind of, well, it depends on their risk. Some newer people want to go into riskier things, et cetera, et cetera. And I think that is the best and advice of it depends, but it's also the kind of like, well, what do I do then? type of comment. So how can you, based on that, how do you navigate giving advice? Not advice. What is your frame of mind? What are things that you would suggest, or how do you think about providing any meaningful information to someone who is looking to invest but is trying to do it that isn't that experienced?
Yeah, it's a great question. How do you start, right? And
Yeah.
No investment advice, of course. We just
Yes.
kind of thinking out loud.
Yes, exactly.
So ready, fire, aim, right?
Yes.
So if you don't start, this is the beauty about life. And I've taken this originally through chess, that approach. You study, so you have to learn.
Mhm.
At some point, you have to play the game. You have to practice what you just studied, and then you analyze, and then you do it again and again. Life repeats. So ready, fire, aim, and re-aim and fire, and re-aim and fire until you get it right for yourself. You don't know what you don't know. And I like this expression. I've said it many times. It's always in my mind. Are you learning to invest or investing to learn? So as you go to the price, it's always both, ideally, right?
Yeah.
So anyone who's listening and they're thinking about this, you want to do enough study so you feel comfortable to pull the trigger, right? You just don't know when you're ready. And if analysis paralysis, you can analyze until you turn blue. So at some point you have to figure out, do you want to be active or passive? Do you want to buy a property near where you live. Some people prefer that. And they just don't want to invest with other people. They're not comfortable, which is fine. Then save enough and buy something near your home. Maybe buy your primary thing and then buy your secondary thing, and then you can rent it out. I met with a great friend. Actually, we grew up playing chess in Moldova.
Nice.
And he lives in Boston area. He's super smart guy, and a little weirdo. He's a weirdo from the point of view that he buys real estate without ever getting a mortgage. He had successful exits in high tech. I mean, he's a biotech. He's actually a doctor by education, long story short.
Cool.
But he worked for biotech companies, had successful exits, took multiple millions of dollars, bought real estate with it, all of it for cash, no mortgage, right? He's extremely comfortable. He deals with these tenants and toilets directly, and he's happy it works for him. Is it a good scenario? It works for him. Plenty of people, they don't want to deal with any of this stuff. They just want to build know, like, and trust. These are magic words.
Yes.
We do the same when we write a check, because when we invest with somebody, we have to know, like, and trust that these folks are neither shysters nor idiots, right? That's minimum requirements. And basically, they hopefully will be good stewards of your money. And then you start with the jockey, then you get into the horse, right? So if you get comfortable investing with somebody, you start somewhere on some deal, some asset. And as you invest, monitor the investment, learn from your investment. Okay, quarterly report. What's happening? What's the cash flow? What's the occupancy? What's changed? If things don't go well, you learn more than if things go great, right? Things go great, things just gonna look perfect. But you learn from the investment, take action. That would be my simple advice. Don't look for perfection. Of course, I will go back to yet another great. We mentioned multiple greats, and I walk a lot. This is my daily thing. When we finish this thing, I get out of the house, I walk, and I listen to books. I listen to a lot of books. Over the years, I've consumed a tremendous amount of books, and I've consumed so many books that I'm consuming for like the third, the fourth, the fifth time the same book, and you keep learning. The funny thing about books. So Ray Dalio, right? Where I was going with this. He has a theory on building a portfolio of 10 to 12 non-correlated investments, right? Ray Dalio says some not nice things about real estate because he's a public market guy, right? He doesn't like a few things about real estate. He was, for example, giving a comment last summer that it's not a great hedge against inflation because high inflation rates can spike and they can hurt real estate. True on a short, response. But his theory of 10 to 12 non-correlated investments is correct. And it applies to any investing. So you can have some stocks, some Nvidia, some Google, and then you can have some, boring utility companies, and you can have some healthcare, pharmaceuticals, and you can do some industrial real estate, and then you can do something open air shopping. So you could build enough of these non-correlated investments. You can have some gold, right? You could have some crypto, whatever, makes you happy. So as long as you follow those principles, they're important. And if you're trying your first thing with real estate and private real estate, get comfortable with the amount of capital you can deploy. That's one thing about stock market versus private real estate. One of the differences, you can buy stock market with small amount of cash, just go buy, small number of shares. With real estate, it's going to have to be some kind of reasonable lump sum. What that number is, maybe minimum number I've seen, 25K, 50K, 100K. If you've done well, look at your whole portfolio and make sure it's not too small. So you don't have too many things in your portfolio. It's not too big. Then you're not diversified enough. So, and that number changes over time. It's kind of funny. We evolved. We used to write small checks into deals, like passively, 100K, 150, 200. And now, at minimum, we want to do $1 million. Why? Because just you're too small. The impact of the investment doesn't move, a needle in your cash flow. So you got to think about right sizing, but remember, you're trying to learn. Because you're trying to learn, you don't want to go too big, too much, too fast. So do one, diversify over time too. Market cycles. You don't know if a cycle is an uptick or a downtick. That's why spread it a little over time just to see what happens.
Yeah. This makes so much sense to me. And this whole conversation, and I really thank you for all this knowledge and kind of, I would say, sparring with me on this one, because, I know I'd put you in a tough position with with that question of where should people start, et cetera. But where you went with that on Ray Dalio and the uncorrelated assets is what he calls the holy grail, And so the next logical thing, like you're talking about, is really asset allocation and how much of your own net worth can you invest into something available, investment net worth. And so it seems to that it's always depends on the person, but starting with something, educating themselves enough, learning to, investing to learn. And it's kind of DevOps if you think about it, man. But it's like
it tickles your mind to think about it. That's why I like the phrase, because it tickles your mind. It gets you thinking. And that's the intention, is to stimulate thought and continuous learning. The whole life is continuous learning. As long as you're doing this, you're actually having fun.
Yeah.
And if you're having fun doing this, even if investment doesn't go perfectly, you will get a PhD in investing and lose a portion of your money. Well, you got your PhD by learning.
Yeah, that's the infinite game. And okay, so asset allocation, definitely go there, because that is starting with something that is, perceivably lowest risk that you can, and then, pulling the trigger, so to speak, and learning. Totally up.
I want to talk about asset allocation because we live in the age of AI, right? We all, the techies especially, we consume it every day.
Tell
I
me
have
about
my favorite tool. So, but I did ask Perplexity. It's a good research tool. I did ask you, what percentage of your portfolio should be in real estate? I did ask it. And it gives you ranges. And there's some caveats and conversations. And it was interesting, the answer that I got, between 25 to 40%. I said, oh, wow, that's a lot.
Yeah.
I thought that was a lot. To me, yeah, I'd be there all day long. But to many people, it's too much. But I think it includes their primary residence. So the primary residence could be pretty valuable. So if you're in the Bay Area or New York City, could be a lot of your net worth concentrated in real estate.
Sure.
So you could have a sizable chunk of your portfolio. And there's no right or wrong. It's just more of how comfortable you get. As I said, my friend who's in Boston, he's the chess master and the duck. I saw him a few weeks back, like a month ago, and I'm still fascinated and amazed. He's taken, every time he goes through a biotech successful cycle, he exits, he takes the cash. And I was shocked. He says, I took all that money and I bought real estate. No mortgage.
Wow.
So he's the most conservative strategy you can imagine. I think real estate is actually pretty conservative. And no mortgage is insanely conservative. And I told him many years ago, get 50% leverage. And you would have a lot more money now. This would have grown, appreciated so much more. And he absolutely recognizes this, and he still does the same thing. And by the way, he doesn't use credit cards. He never uses anything other than. So it's hilarious, but it's a mindset. We all have our own values and beliefs, and you could follow it.
Very interesting. I think Dave Ramsey would be proud. No debt. I only have you for a little longer. I'm kind of curious, and I'll give you the magic wand or magic whatever you want here to speculate, Mike. But no repercussion, no recourse. Where do you think that? How are you seeing AI impacting real estate investing?
Yeah, I love the question, by the way. It's a brilliant question. I have a brilliant answer. I used to have wonderful crystal ball, and it broke, and I can't find another one for sale. So everything from here is pure speculation. I don't really drink. I drink my tea with the Buffalo Bills cup. Unfortunately, they lost unfairly, in my view, but it's another conversation. But let's talk about this. So AI. This is going to be high level, and there's going to be a lot of forward thinking. Sure. From what I learned in years in tech, it's highly deflationary. It's always been the case. Tech innovation, Moore's law. If you think about it, what it says, Moore's law says every 18 months, the cost of the chips halves and the computing power doubles. AI chips it's double Moore's law, from what I understand. I don't know exactly, but what I heard is double Moore's law. So things are moving faster than before. So you have effectively significant deflationary environment, and the productivity growth and automation is going to accelerate anti-inflationary pressure, in my view.
Can you explain that? It's a deflationary environment.
So again, the chips themselves, deflationary. Think about this: technology, and AI is creating much higher productivity. So think of it this way: a couple of months ago, I needed to do an extension on a promissory note, just a loan, So instead of giving it to a lawyer and paying $1,000 or $2,000 to extend the loan, I basically punched it into, I can't remember which one. Maybe I used Claude or ChatGPT or Perplexity, one of them. And I said, extend me this note for 2 years with the same terms. Boom. It read the note, it knew everything else, and it spit it in a legal document that I could use. Now, if it was a super high value note, maybe I should have a lawyer look over it. But think about this. What just happened within seconds? It created a work that used to cost a few $1,000s. Mm-hmm. That's deflation, right? That is a reduction of the cost of goods and services.
Got it.
And you can do many things. You can extrapolate so many things. Obviously, various chatbots and support. And used to be support engineers answering the phone calls. Now it's an AI agent, sales automation, all kinds of things. I have a new book coming out, and I use Claude as a first-time editor. I would have to pay editor to pay a lot of money to an editor to edit the book. Now I use Claude. Every chapter, I gave it a prompt, and it knew exactly what to do, right? So the point is deflationary environment overall, anti-inflationary. We may see slower inflation than people are afraid of, and that could mean lower level of interest rates. Now, this is speculative. We don't know that. But I believe over time, with significant progress with AI, robotics, we're going to see lower level of inflation, higher productivity, and lower cost of goods and services. And as a result, we're going to see lower level of interest rates, right? If we see lower level of interest rates, it's a good news for real estate on a macroeconomic picture. You can argue national debt, the size of national debt service, and all that stuff. The politicians will still find ways to overspend and borrow more and create problems. But we're talking about impact of AI. I really feel that it's productivity gain and technological progress will create an environment where we will see significantly lower cost of certain goods and services. And it's obviously for tech, but for tech coding, right? Coding tools. Think about it this way, right? So now you need way fewer engineers. You need maybe more seniors who can direct agents and do all that stuff. And you can accelerate the process. So the value of work, the value of hour, the productivity goes up a lot, right? So that's the concept, which means you can earn more if you're highly productive per hour. But at the same time, the result of that work will be lower cost of underlying software that does all kinds of other things.
Yeah. And I mean, that is across the board. That'll be really interesting how that shakes out, because there's so many factors that go in. You're talking about that from a productivity perspective of, we'll say, quote unquote, white collar work, but also from a, services that must be done physically, like 3D printing houses, right? Labor costs, as an example, let alone what that looks like to have, agents working in robotics to be autonomous as well, to do things, who knows, right? But there's a lot there. But you mentioned a book. I will buy your book, Mike. I'm excited for it. I saw your first book, The Real Estate Investment Fund, How to Choose a Smart Real Estate Investing Fund, the top 10 biggest mistakes to avoid before investing. Tell us about your new book.
So it's done. It's been done. It took me only a few years to do it. I persevered during the Q4 of 2025 to finish it. And it's coming out by the end of this quarter, by the end of Q1. So folks can actually sign up to get a copy. We will send you a copy. If we, at minimum, we'll get you an e-copy. The title, there's a few possible versions. I'll give you one possible. It's probably going to sound like this. It's going to sound like Predictably Wealthy. Right? Real estate, the key word is predictability. It's the differentiation between stock market and real estate. So, and it'll talk about all the things that we talked about, market cycles. It'll talk about different asset classes, strategies, diversification, a lot of the things, and it's full of stories. The original version of the book was tech guy mumbo jumbo that was just too dry. And the feedback I got, everything has to be a story, somebody's story. And it's been rebuilt with many stories that, true stories from life, interactions. So I hope it's going to be a little bit of exciting read. You can learn on the way. So it's coming out. Let people go to bigmikefund.com. There's a place to sign up. And I think there's a place for you to go request a book or sign up. And then when the book comes out, you'll get a copy or get at least a copy.
So good. Awesome. I'll make sure that is in the show notes as well. I'll definitely be getting it. I always think about, books and
Wait, I forgot to correct the joke, and I got to correct the joke because
do it.
these podcasts are so wonderful. So every time I do this, bigmikefund.com, but if you misspell it, you go to bigmikefund.com with an N at the end, not D. D just got lost, right? I promise it's not a kinky site.
So try it out, folks. See what you get. Maybe I might put the quote unquote wrong one in the show notes for you, but good stuff, man. I mean, every time I look at one of these books, I always think about the years that went into these lessons and how they're accessible, for me to pick up, way too cheaply for the wisdom that you get. And your comment about listening to audiobooks for the third, fourth, fifth time, one of these quotes that really impacted me was, like anytime you go back to a book and you reread or hear it again, or you realize there was something new. It's not that there was something new in that book, but there was something new in you that compounds that knowledge. And so I love that you have stories in there as well. You comment on who, not how behind me for anyone who's watching here, but also things like, EOS traction or Patrick Lencioni's on management, things about, fables first. And I have a dream, Mike, where we write a book where it's a similar type of format, just like that, but it's on real estate and then the lessons afterwards. So maybe that's, I don't know, maybe someday we partner on something like that.
I'm happy. I really enjoyed this conversation. And yeah, let's keep chatting. You never know.
Yeah, man. Thanks so much for being here. Guys, check out his stuff. Mike, thank you for being here, and we'll see you next time.
Thank you.
Thanks for joining us on another episode of Path to Passive. We love connecting with our listeners and those on the path to architecting their wealth and improving their lives. Feel free to let us know what topics you'd like to see in the future episodes. Get in touch with us through email or Instagram. See you next week for a new episode.